Have you ever looked at a graph of price movements of a stock, bond, or index and wondered, should I get in? Should I get out? Should I do nothing? You're not alone. In fact, there's an entire discipline that uses little more than price and volume and various technical indicators derived from them to try to answer these questions. Stay tuned as we explore the little-known world of technical analysis right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I am your co-host, Roshan Loungani, here as usual with Erik Olson and Adrian Nicholson. I say as usual, although Erik, you weren't with us last week. How was hiking?
That was incredible. 45 miles through the backcountry of Pictured Rocks National Lakeshore. I got to tell you, it was... I could hardly come back indoors. I felt like being indoors again seemed alien and like I was being trapped. So it's so funny how being outdoors that just in that setting that way changes your perspective. So it was fantastic. How about you guys?
Hey, Erik, I'm glad you're back. And I heard it's good to sometimes just disconnect and kind of go out and just really experience everything. That's really good. I have a quick question for hiking. Is it common or uncommon for people to bring like pets or animals on hikes, or do people normally just, you ever see that at all when you're going hiking?
Certainly for hikes, less so for backpacking, because then it's just one more burden of food that you have to carry unless you can put that weight on the back of the pet somehow. So I didn't see any backpackers with pets, but I saw a lot of day hikers with pets for sure.
Yeah, that makes sense. But happy to have you back and excited for another episode. How are you doing, Roshan?
Great. Good week and nothing too interesting. Went to New York, which was, I guess that was interesting to see. It looked pretty close to back to normal in terms of how busy it was. I remember seeing pictures of Times Square during the pandemic, and it was empty, which just is so strange. I heard the same thing from some friends up there, but we went this weekend for my wife Steph's birthday, and she loves New York, had a great time. I get excited to come back. Kind of the polar opposite of Erik, your trip in terms of going backpacking versus going to New York City.
Well, it's a fascinating place, and it has its own wildlife, doesn't it?
Yes, yes, it does. You know, one of our drivers when we were in an Uber said to us, "Yeah, there are a bunch of weirdos here." And then afterwards, my kids are asking, "Well, what's a weirdo?" they I don't know if they thought it was like an animal or something. We want to see a weirdo while we're in New York. So we moved on from that conversation, not with a great explanation, just changing subjects real quick. And I'll do that now as well and bring us on to the topic of today. I'm looking forward to this one. So today we're talking about technical analysis. Now, typically when you look at analyzing investments, more specifically equities, people will look at it in either quantitative or qualitative. Qualitative being looking at the fundamentals, which are getting through the 1040, looking at all the accounting and doing ratio analysis, price to earnings, price to book. The other side, quantitative, is more technical analysis, where you're looking at price and volume tend to be the drivers of what you look at here, and charting, price movement, things like that. So we've definitely talked about the qualitative side in the past. Today we'll talk about the quantitative side, which is technical analysis, as we're going over it today. So gentlemen, just to start us off, I know Erik, you had said you wanted to talk a little bit about the history of technical analysis. Do you want to start us off there?
Yeah, sure. I would say, I think in the deep history, you can go back a ways and look at, back into the 1600s and such. But for the most part, I think the formalization of technical analysis first occurred in a meaningful way in Japan, with one of the traders there was watching the rice markets and figured out a way to mark what he saw as the opening, closing, high and low prices of the day in a certain charting approach that's today known as Japanese candlesticks, and was not really popularized here in the United States until sometime in the 1990s by a fellow named Steve Nissen, who wrote a pair of books on this. And I think that has in many ways really transformed the way in which U.S. traders and traders in the West have looked at chart patterns and price patterns. But then probably in the United States, it was in large part attributable to Charles Dow, who in the last 15 years or so of the 19th century was making observations about the movements of the markets, looking predominantly at trend movements and formalizing as well certain patterns that he identified, reversal patterns, continuation patterns, and so forth. And by the early part then of the 20th century, others who started to find value in some of his observations took what came to be known as Dow theory and extended and formalized that still further. Hamilton and Rea were two of the big names that did that. And so, over time, I think it was looked at as sort of the somewhat embarrassing stepchild, if you will, of market analysis, and people would generally say, "Look, let's approach this from the vantage point of the fundamentals, as a chartered financial analyst would do." And those market technicians, they're just a bunch of witch doctors and voodoo practitioners, etc. But over time, it came to be that even an organization like the Securities and Exchange Commission now recognizes two designations, each which is with its own value in providing market analysis, which are the CFA, the Chartered Financial Analyst, as well as now the CMT, the Chartered Market Technician. So it has come into a position now of credibility over time that took us over more than a century to earn, but today it's certainly regarded as a legitimate way of analyzing markets, and hence I think it's valuable for us to talk about it.
Yeah, and what I find interesting with this is Charles Dow, known for the Dow Jones Industrial Average, it also is considered someone who, in the United States, popularized technical analysis. So not just known for one, and he was a reporter, right? And not necessarily a trader or anything like that. He's known as a reporter too. So I find that part of the history of technical analysis really interesting.
Mm-hmm. Yeah, some of those people who weren't traders necessarily made a lot of money using these systems, but just by selling newsletters and stuff. So there's a lot of people who've come into the field and as market technicians who weren't necessarily traders.
Yeah, and you talk about the newsletters. There's a ton of those as well that focus on all different types of market analysis, stock analysis, technical being one of them. But getting back to the technical analysis, so technical analysis, what they typically believe, if you are trading or investing based on technical analysis, is you believe that all available information is reflected in the stock price, and then you've got a supply and demand issue that will drive the price. So they'll very much focus on price, volume, and then there are various charts, patterns they'll look for. There are, as you mentioned, Erik, Japanese candlesticks tend to be a very, if not the most popular charts to look at, and try to use that to determine which way the market is headed. Do you think that's a good basic explanation of what a technical analyst? Also, a lot of them will go by the term chartist. That's what they're doing. Would you agree? Would you disagree? Would you add on to it?
Yeah, I would definitely agree with that. And I would say price, as you mentioned, is fundamental, and then for some, not all, volume is also critical, because that shows, as you indicated, supply and demand. But some purists will say, well, yes, okay, volume shows supply and demand, but if it's not reflected in price, if that so-called demand isn't reflected in a price move, then who cares? So it's back to price for some of them. But yes, those are the two building blocks, and everything else is a derivative of movements of price and volume changes.
Yeah, and it's a great point. I'll add a little bit onto that. Price is the primary thing they're looking at, and then volume is more for confirmation. If they see a movement in price, the next thing they'll look at is volume for confirmation. So if you're listening to this podcast, we've given basic background on what or the history of technical analysis is. How can you use it? So Erik, is that something that you use or you will look at? How do you use technical analysis?
So yes, I do use technical analysis in some of my systems. So, and then some of my systems are blends of fundamental and technical. And so I would say before I say how I particularly use it, let me just comment about how I think it can be used. And it isn't restricted to the methods or approaches that I use. Some people, I would say, are visual pattern traders. In other words, they're really looking to see if their familiarity with certain patterns largely gives them visual recognition of those patterns, gives them a sense that probabilistically the price is likely to move this way or that way, up or down. And an adept trader who is looking at those trends up or down can invest on the long side or can short positions and profit from those price moves if they're correct either way. But in my case, what I do is I don't rely on my eye. Instead, I rely on a spreadsheet to look at price movements and compare the price movements of different instruments to understand which of those seem, at least to me, to have the best probability of an extension of their upward trend. And I don't do shorting. So in my case, what I use are trend lines, but more instead of trend lines that are sometimes you'll see drawn underneath those series of lows on a rising trend or on a series of highs on a declining trend to see if the trend is subsequently broken. Instead, what I use are linear regression trend lines and then measure the strength of those linear regression trend lines and allow there to be movement up or down from those, somewhat without being too rattled by it. Actually, I'll take that back. The systems that I have built slightly reward something being low in its channel, its trend channel, at the time of purchase, because I consider there to be a likelihood of reversion to the mean as long as there hasn't been a gross violation of that trend. And then I also use some moving averages, which are essentially criteria filters for whether or not something is or is not permitted into the model. But how about you? That's a long explanation of not saying a lot, I guess.
It's a great explanation, and it really shows that you have a lot of tools in your toolbox for your technical analysis system. And I think that's really important. And just to kind of really have these systems and disciplines in place can really help out a long way, and different market environments. It's very important where you're just maybe looking at certain resistance levels or support levels, certain channels, and if it breaks it or it doesn't break it, you kind of have these rules set in place on what maybe your next step might be. I think is really important, especially it takes emotion out of it where you're kind of just basing it on probabilities and looking at patterns and using price trends that happened in the past to kind of make your decision, kind of using as much as you can in your toolbox to base your decision off of, I think is really, really important and can help out a lot when it comes to investing.
Yeah.
So how do you two use technical analysis?
Well, Adrian, I'll let you answer that first, and I'll go next.
Yeah, I really it boils down to two or three things that I tend to look at when I'm looking at a chart. I'll look at support and resistance level, and people aren't familiar with support. Let's just say that a stock has been kind of trading around this, let's say 100 price level for some time. It's kind of gone up and then come back down to this level, gone up and come back down to this level. And it's kind of really consolidating around the 100 level. And let's just say the next week the price has really run up. Let's say ran up to 120, and it's been trading around that level for some time. And then let's just say a month later, it's starting to drop down from that 120 level and looks like it's headed to that 100 level again. Something I would look at is just to see, is it going to go below that 100 level, which would be a very concerning sign, or is it going to find that support at that 100 level, which it was trading at previously? So that's an indicator I look at. The resistance would be, say I was at that 100 price level for a couple weeks, and then it was going to go up to, a week later, it goes up to 120, 125, but it hasn't broken a 130 level that it was, let's say, 2 months ago. That would be a resistance level. And if I see it go above that 130 level, that might be a positive sign. Where it was at a month ago, it just broke that level. So support and resistance is a area that I like looking at as well. Roshan, do you want to mention some areas that you look at in your technical analysis strategy?
Yeah, what I like about this is you have 3 people on here that use slightly different things within the realm of technical analysis. So for me, I will look at those support and resistance, but I will also then look at moving averages using 20, 50, and 100-day moving averages, and I'll use that to help for support, looking for both support and resistance, but also helping that define the trend for me. I will also do the look at the trend lines to try to find in between those support and resistance levels if there are any other areas of support. Or let me restate that. I will also draw trend lines to look between the moving averages to see if I can find additional support or resistance. But and I'm going to state my position and ask both of you, do either of you have a strategy or use this, the technical analysis, as the only tool, or are you using this as one of the many factors you're looking at when you're making investment decisions?
Well, I'll answer that. So there's a variety of, just as in the past, Roshan, you've emphasized that you have strategy diversification. I have the same. Okay. So I have, some that's just classic modern portfolio theory, buy and hold. I have some that is private equity and private debt. I have some that is individual stock selections that are driven strictly by fundamentals. Well, almost entirely by fundamentals, I'll say that. Then I have one that's sort of an intermediate version that blends both fundamental and technical. And then I have one that's purely technical. And in that case, it's entirely momentum and volatility and moving average driven. So it's, I guess I have a variety of approaches. So there isn't a single answer for all of it.
Yeah, I love that answer because I personally
Adrian?
think that's the way to go.
Yeah, I think, that was pretty much the answer Roshan was honestly looking for. And then you do hear the stories of people literally making a career off of just one technical strategy, and it's worked for them for the past 20, 25 years. And this is why you have to have a conversation with them, because it's just so awesome. Hats off to those people. But like you already know, just having multiple strategies just really helps, and just having different ones or having something to add to your overall kit can really help out in the long run. And just having areas and different indicators just to refer to help you make that decision, it could always help in the long run, I think is really important. And going back to another one I like as well, and I think this is a technical, not a fundamental one, but I'm not sure if you guys address it. It's the moving average convergence and divergence. That's also an indicator I look at, where it kind of looks at the price momentum of a stock based on volume, where if I see like a sharp negative crossover, that's a very concerning sign, especially if it moves below a moving average. That could be a really aggressive sign. Or it could be the opposite, where let's just say a stock is trading at 100, moves to 105 and crosses above, let's just say like a 50-day average, and the moving average convergence and divergence is showing a sharp positive upward crossover. That could be a really positive sign if it comes to moving into a particular investment.
Yeah, I'm going to come back to this. I'm going to first answer the question that I asked earlier, which was just to give the listeners a different perspective. The way I use this, and as I said, I'm a fan of multiple strategies. I use the technical analysis, the moving averages and the trend lines as an additional factor with one of my stock-driven strategies. Now, going back, Adrian, to what you had just said about convergence and divergence, I will definitely look at it. I think there's at least the scariest term I think in the business is death cross, when you're seeing the trend lines drop below, the moving averages drop below. So I don't know that it's not a foolproof indicator, but it definitely sounds ominous whenever you hear the talking heads say, we've got the market just had a death cross, or talking to colleagues and using that term. But Adrian, Erik, I think you had an answer.
Yeah, and then isn't there the opposite of to it? There's a
golden cross.
Well, isn't there an opposite to it where there's a death cross and a golden cross too? Isn't that like they're kind of polar opposite twins or something like that? So there could be really good indicators and there can be really bad indicators that keep Roshan up at night. That's for sure.
Yeah, but the golden cross, though that sounds good, it doesn't have the same effect. I'm not as excited with the term golden cross as I am fearful from the death cross term. That's just the semantics, though.
So, listeners, I just want to suggest how this might be of value to you. So, all of this language, or all of these specialized jargon, and all of these indicators and so forth, are really designed to accomplish one main thing, and that is to essentially help you identify the next likely direction of price. And with that, then if you can have a probabilistic edge in doing so, then hopefully more times than not, you can participate in a price movement. We call that a trend. You can participate in a price movement that serves you well. And generally speaking, all of these different tools are looking at, is the trend still in effect, or has it come to a halt? Is it weakening? Is it taking a rest, or is it and then going to continue, or is it going to reverse, etc., so that you can be properly positioned on the right side of a trend, up or down, if you're long or short. And so the tools, we've mentioned a lot of the different tools, moving averages, trend lines, oscillators like the MACD, the moving average convergence divergence system, and many, many others. So what I would say is a simple system for you might be something like this. If you were wanting to do something along these lines for yourself, find your favorite trend indicator, and I would say moving averages are a great and simple version of a trend indicator, especially if there's a lot of agreement. If a 10-day or 10 period, and actually we should probably talk about using multiple time frames to evaluate trends, because something that Dow had initiated was major trends, intermediate trends, and then minor trends, and we look at it in the same way. Multi-year trends, multi-month or week trends, and then trends of a few days or weeks or something of that kind. But if you have agreement on a number of these trends, and those are demonstrable through these agreements of various moving averages, a 10-period moving average above a 20, above a 50, above a 100, above a 200, let's say, you probably can say we have an upward trend, or vice versa. If they're all stacked in the opposite direction, we have a downward trend. Then you have to figure, where would I enter this trend at the lowest risk point? Or how do I at least reduce the risk of entry? And so typically an oscillator helps with that, because if you can find something that has, we say, pulled back within the primary trend to an area of, using Adrian's language earlier, an area of support, I'm talking about an upward trend now, pulled back into an area of support within the context of its still unbroken upward trend, now you can say, all right, I have an opportunity to enter here and rely on what we consider to be probably the reversion to the mean, and a sort of that instrument that's pulled back against the major trend to now rejoin the major trend. You have a definable point of entry, and you can put a risk or a stop risk measure in place to say, but if I'm wrong, if what I thought was a pullback is in fact a trend reversal, I won't allow myself to stay invested long in this position if it breaks below that area of support that I had previously identified. And so you limit your risk that way. And then, but if you're right, you can let your winner continue to run. And then the final question that people have is, well, okay, I found a trend. I found an acceptable entry point into that trend. How do I figure out how to get out? And so that then calls for some sort of exit signal. And that's a much tougher business for most people. And so what many people do is they say, okay, I have certain definable multiples of return that I'm looking for. If I had put at risk, let's say, I'm just making up numbers now. If I'd put at risk $1,000, then once I'm in the money to maybe $1,500, I'll take a little off the table, and I'll raise my stop, let's say. Or maybe if I'm 2,000 into it, I'll raise my stop and take a little money off. So it's a partial sale process. But for other people, they say, all right, forget about it. I'm not going to do partial sales. I'm just going to stay with the trend until such a time as I have confirmation that the trend has reversed, and at that point, I'll exit. So that, again, there's a big literature on every single one of these things. How do you measure trend? Which oscillators do you favor to find that something has pulled back to support, and how do you exit? But you can have a lot of fun with this. There's plenty of information on the web about all of this, and these are strategies that people have used with great success.
Yeah, those are some great points, Erik. And I guess this is a perfect question. Do you view all this as a science or an art?
I would say once upon a time it was an art. And I think some people still practice it as an art, but I do believe that you can. I would slightly differ with the way that you framed it in the beginning, Roshan. I would say that you can approach this quantitatively, just as you can approach the analysis of fundamentals quantitatively. Similarly, you can approach the analysis of technical indicators quantitatively, and therefore you're able to measure whether certain appearances of a certain conglomeration of indicators, whether the subsequent price movements on a probabilistic basis are there's higher probabilities with one setup than with another setup. Let me give you just a simple example. So if I see, let's say,
I need to interrupt you. I need to interrupt you for
Sure.
a second, because first, just to clarify, one. I was just using the definition of what quantitative analysis is versus qualitative, right? Like that's somewhat of I hesitate to say industry standard, but I pretty much, quantitative analysis is known as technical, and qualitative analysis is known as analyzing the accounting documentation. So that's not a comment on one being
I see.
better or worse than the other. It's just classification.
Oh, okay. Okay, all right. Fair enough. So, fair enough. I'll look at that way. So, in any case, I would say an example of this, using some of the language that we've used here already. Let's say that you had because Roshan, you mentioned 20 period and 50 period moving averages. Let's say that something has been in an uptrend. All those moving averages are moving up. Then the price settles back into an area of support at a 20 period moving average or a 50 period moving average. And using your language, Adrian, the MACD, moving average convergence divergence thing, confirms that, hey, it's resuming its upward trend. Then you get in on that and you purchase. So you can measure when that setup occurs. Does that approach work better if you use the 50 period moving average, the 20 period moving average, the 10 period moving average, or something else? And similarly, you can say, does a MACD oscillator or Wilder's relative strength indicator, RSI, or some other oscillator do a better job of signaling it? So, and then what's the necessary value that it has to have reached? And there's all sorts of ways of framing and examining the question, but you can frame it. And then you can use lots and lots of historic data to evaluate, in general, which of those setups has the strongest probability of continuing the price in the direction that you want. I'll mention one other indicator that I really love, and this is also by Wells Wilder, was his name, and who was a genius at developing these indicators. It's the average directional indicator, ADX. And that the ADX shows a strength of trend, and it shows whether the trend is in fact not only strong or weak or in between, but whether it's strengthening or weakening, even though it may be strong or weak. So there's a lot of applications there that I can think for traders who pay attention to that can do themselves a favor and keep themselves out of wasting time on trends where there isn't a sufficiently strong trend yet. That may look like a trend to the naked eye, but isn't strong enough yet to warrant entry.
All right, and I actually want to answer your question, Adrian. And this is in no way a knock on technical analysis, but I don't think science is the best word to describe it. I don't know that art is either, quite frankly. And what I mean by that is, I think similar to fundamental, both quantitative and qualitative, fundamental and technical analysis, neither of them are right 100% of the time, right? And I don't know if I think if you talk to people about technical analysis, charting, or you analyzing the charts, they're going to say you need to learn how to read them, and you can show the same chart to different people and see different expectation. One person will look at this chart and say, I think I should buy now. The other one will look at the chart and say, no, I think I should sell now. For that reason, I would just argue that it's not, that I don't think science is the best word. Erik, you mentioned at the beginning that at some point people thought this was like voodoo, the technical analysis. I'm bringing that up again to say I by no means believe that either, right? I just think, for me, science is too powerful a word to define any of these analysis tools. They're all used to put the odds in your favor, or to use an industry term, to give you an edge. And that's how I think you use both fundamental and technical analysis.
Yeah, I agree with that. And so there, you use to give yourself an edge. I'm just going to borrow a word from that statement, which I think summarizes the difficulty of all of this, which is traders also refer to the hard right edge. What they mean is the right edge of the screen, yes, where you're trying to make projections into the future, and it's a tricky business. So but I do think that there are tools and approaches here that one can learn and put to good effect. Having said all that, I would say the lion's share of the assets that in my own portfolio and the assets that I manage I do not manage using purely technical measures, and there's a large share of them where I don't allow technical measures at all to influence the decision making. So this isn't either or. It's the question of whether or not it makes sense to have some part of your portfolio participating in the opportunities that technical analysis offers.
We've talked at length before about multi-factor investing. This is just another factor that I do believe is worth including. But and Erik, you have a strategy you use that exclusively uses technical. I have one that uses it as a factor, but either way, we're both using multiple strategies, and I don't think there's a wrong answer. I don't remember exactly what you said, so I can't quote you, but at one point you had said, find the indicators that you're comfortable with and that you can use. And I think that investing in general is partly a search of finding those things that make you comfortable and make you feel like the odds are in your favor. We talked previously about a variety of different investors. We talked about growth and value. And what I'm hoping that our listeners will hear from us is that there are a variety of different ways that you can invest successfully, and you've got to figure out which is the right one for you. Benjamin Graham, known as the father of value investing, he spends a lot of time in his book, The Intelligent Investor, talking about behavior and temperament. There's an entire area of study in finance now called behavioral finance, and I think that's part of it as well. You've got to figure out which one of these methods line up with you almost at your core values as an individual, will line up then with your investment approach or strategy. And I think they're all valuable. I think they're all they all can work. You've just got to figure out what's right for you. Gentlemen, I think we did a a great job covering the basics of fundamentals, the history. I should start with in the order: the history, some of the basics, some of the approaches that you can use, some of the different indicators that we look at. I think we've done a good job with this one. Unless you have anything to add, I think we can wrap it up.
Great. Good stuff, guys.
Yep, all set.
Yeah, for everyone that joined us, thank you very much for listening. We appreciate your time. This has been another episode of the Retirement Lifestyle Show. Please like, subscribe, tell your friends, family, forward, give us 5 stars, spread the word. We are continuing to grow. We're really happy to report that with the podcast. We've got us on YouTube now, and we've got the website, retirementlifestyleshow.com. And we'll be back to you next week with other additional valuable insights in the world of finance.